Everyone active in the financial markets wants to know how much risk they're taking. One difficulty is being able to estimate what a particular underlying instrument's volatility or risk will be. This uncertainty is measured by different people in different ways. The options market provides insight into how much uncertainty the market anticipates. Greater uncertainty generally leads to higher implied volatility levels. Implied volatility is a measure of expected future bounciness of the underlying, as opposed to realized volatility, which is a measure of what has already happened. Using option pricing models, market participants have been able to calculate the implied volatility of specific options at specific strikes. The collection of these implied volatility levels with the same expiration is called the implied volatility curve. Looking at a sample volatility curve, assume that the at-the-money strike has a volatility of 40, a way out-of-the-money put has a volatility of nearly 70, and an out-of-the-money call has a volatility of 45. If these options are all derived from the same underlying instrument, how do you know which volatility level is the best to follow? If the 40 volatility is correct, does that mean that the volatility of 70 is wrong? Traditionally, the at-the-money strike's implied volatility has been quoted as representative of the expected risk. But we can see that the out-of-the-money options are implying higher volatility for the same asset in the same time frame. As every strike on the curve has a different implied volatility level, that begs the question, is there a way to interpret these option prices into a single, meaningful volatility estimate? Yes, there is. Introducing CVOL, the CME Group Volatility Index. The CVOL index is based on the variance estimate. Variance creates one value by using every single strike on the implied volatility curve, thus capturing all the market information and distilling this aggregate to a single number. How does this aggregation work? Looking at a range of option strikes with the same expiration, we see that further out-of-the-money options are priced lower than at-the-money options. For example, the 35 put is priced at 0.10, while the 55 put is 250. To demonstrate the variance estimate, the option prices are plotted vertically with the strikes arranged across the horizontal axis. Shown in this manner, the out-of-the-money options begin to reveal a smooth curve as the strikes approach the price of the future. Since only out-of-the-money options are used, there is a boundary at the price of the underlying future, which is 57. As the out-of-the-money calls are added, we see the curve being mirrored. The measurement of the area under the two curves is representative of the implied variance in this set of options, with the option prices as a height and the average distance between the strikes as a base. Individual areas under this curve can be calculated. These areas, shown as rectangles, can then be added together to estimate the total area under the curve. The total area under the curve is the variance, and the square root of variance is the standard deviation. When annualized, the standard deviation becomes the usable volatility number that is representative of the prices for all the options, rather than simply the at-the-money estimate often used as a quick reference. The variance estimate can be calculated by anyone, but the process can be time-consuming with the risk of inaccurate calculations. The CVOL index provides a daily estimate and a historical dataset calculated using CME Group's methodology on its own options prices. Initially, 2 years of historical data are available on 5 currency pairs, as well as the 10-year Treasury note contracts. The CVOL family of indexes will be expanded to include benchmarks on other recognized and established CME Group products. As with other implied volatility historical data sources, this data can be used for analysis, event triggers, or strategy-backed testing. Because this method is the same for every asset class, volatilities of multiple asset classes can be compared to each other on a level field. For example, the 10-year note shows the implied volatility derived from option prices observed during the year 2020, while the British pound implied volatilities highlight certain 2019 macro events, such as Brexit-related news. The individual product indices can be aggregated to create a broad-based index that tracks the implied volatilities of multiple products together. Initially, an FX index will be offered, which is composed of the 5 currency pairs. More broad-based indexes will follow in the future. Available on CMEgroup.com through CME Datamine and QuickStrike, These calculations are made daily, updated at the end of every trading day, and stored in a downloadable format. CVol indexes from CME Group utilize the simple variance estimate method to provide expected volatility metrics derived from the entire implied volatility curve.